ahead and get started here. Hello, and welcome to our discussion on process automation in banking. This is a hugely important topic, and it holds a lot of weight for Finserv right now. I think through the information that we're going to go over today, you will see why. If any questions come up during the presentation, you're welcome to pop them into the chat. Of course, you can always email us later with anything you think of after the fact, and we're happy to get those inquiries answered for you. The event is being recorded, and so we'll make sure that you get any relevant assets necessary after the webinar. With that, let's get started. All right, so before we dive in here, you probably want to know who is talking to you today. So here are some quick highlights about us. We are Technology Advisors, Inc. We're a digital transformation company out of Chicago, and we've been doing this for about 32 years now. Our main approach is strategic software selection. And what that means is basically, we're not here to just throw a software solution at you and hope for the best. The way that we go about helping our clients acquire software is very thoughtful. We look at not only the goals you're trying to accomplish, but the existing software that you have and how that might tie in with the software, the budget you have, and we try to align the solution that you choose to the specific use cases you're trying to accomplish. Sometimes the client knows those specific use cases. Sometimes they're a little bit more general and they say, oh, you know, we want to be more productive and we want to innovate faster. What we do is help you get more granular about exactly what that means so that we can find a solution that has the features that match your needs. We're also expert integrators. We've been doing that for over a decade. We use our proprietary iPaaS solution, which is an integration platform as a service. What that means is an iPaaS can connect anything to anything. So it's really a dynamic way to connect systems. And then this is the thing that I really wanted to point out the most about us is our full SOC 2 compliance by the end of the year. Some of you may be familiar with SOC 2 compliance. For those of you who are not, it's just a voluntary compliance standard for service organizations. The American Institute of CPAs put this together, and essentially it specifies how organizations should manage their customer data. It puts forth standards based on this trust services criteria that they have. So that's around data security, data availability, processing integrity, confidentiality, and privacy. So the good news is we were already doing pretty much all of this, but you know, just by having that third party come in and put their stamp of approval on it, we just thought that was something that was really important for our financial services customers, to give them additional peace of mind in how we're handling their data. And then we also do custom software development. So, you know, you might find a solution that ticks 99 out of 100 of the boxes that you want to tick. But maybe there's one field or one function that you just really would be a nice to have. That's where, you know, our custom development team can come in and make those changes for you. All right, so let's do some intros. My name is Deneen Madura. I'm the Marketing and Content Director here at Technology Advisors. And a big part of my job is getting to the bottom of trends and challenges that are affecting our customer base. So not only we can create content that's useful to them, but also so that when we are helping research the solutions that are the best fit for them, we're coming into that with an educated background on their industry and the trends that are affecting what they do. So that's part of the information that I'm going to be presenting to you today. Then we have Megan Sheehan, our Director of Project Management, who's going to be showing the process automation demo later in the presentation. Megan is a math whiz and a process management genius, if I do say so. She really has this incredible ability to translate complex ideas into standardized processes for our customers. And she's applied that in many ways for quite a few years. So there's really no one better to take us through the process automation demo than Megan. And then Our silent observer today is our CEO, Sam Biardo, our founder as well. He's standing by and listening in, and he's going to be following up after the conversation just to find out if anybody has additional questions. He's very knowledgeable in terms of all of this topic matter, so he can provide some additional insights if need be. All right, so what exactly are we going to talk about today? Well, a couple of things. First, we're going to look at some of the biggest forces at play for banking and Finserv. And part of that are technology challenges and opportunities, but also trends in the industry and the market itself. Then we're going to look at how the tech trends of today are helping banks to compete on these forces and how that all ties in with this process automation conversation that we're having. And then at the end of the presentation, we're going to discuss process automation in action and show you what that might look like. So let's start by taking a look at some of the market factors and trends that are influencing banking and Finserv right now. Apologies, I tried to get this not blurry through every variation possible, but it just wasn't happening. So you can still get the general gist, but according to a Deloitte report in 2018, the digital banking landscape was already increasing prior to the pandemic. Globally, banks were planning to invest over $9.7 billion to enhance their digital banking capabilities, and that's just in the front office. Now, then you get this 2-year shutdown, and boom, you intensify that digital banking adoption. So now there's not just a demand for rapid digitization, but there's really this need for it. And so this graph is from BCG Retail's Banking Pulse, and it shows just how much that demand accelerated in 2020 alone. We see a 30% increase in mobile app usage and a 23% increase in online banking. And then if you look to the right, the predictions for its uses post-pandemic, not quite as high, but still pretty strong. So this push for faster digitalization is really rippling through the entire Finserv ecosystem right now. Let's take a look at some other stats around this digitization push. A Deloitte survey in 2021 showed the effects with how Finserv executives viewed their digital assets. 45% of them believe that custody of digital assets will play an important role in their organizations. And here's a fun fact that supports that. Digital is now the top channel for US borrowers to purchase home loans. I mean, and the home loan market is booming right now. So that's tying into what these executives were expecting. Last year, BDO in July, they polled 100 C-suite executives at mid-market banks, credit unions, and other lending institutions. And what they found was that most organizations have developed digital transformation strategies, and nearly half are also accelerating those existing plans. So in addition to this digitization, there's also been workforce upheavals. We've all heard that term, the Great Resignation at this point. Unfortunately, Finserv and banking is not immune. The financial services industry has suffered from labor shortages that are caused not only by the pandemic dislocation, but also by some industry-wide trends. And we'll kind of dive into those trends a little bit more in the next slide, but just as a preview, you've got younger veterans leaving their jobs to branch out on their own. You've got these disenchanted junior executives who are gravitating towards this exciting world of fintech. And then you've got a booming sector that is compelling companies to outsource non-core functions to fintech. So overall, in the US job market, there were 10.4 million job openings in August, but 4.3 million people at the same time quit their jobs. So that number declined in October of last year, but hiring still dropped significantly. The financial services and insurance industries, as you can see by this number, they represent 96,000 of those payroll drops. So what are the reasons behind these workforce upheavals? Well, a couple of things. There's a general dissatisfaction with work-life balance. In a recent Goldman Sachs survey, they got a scary result. Most of their first-year analysts were characterizing work conditions as inhumane, 100-hour work weeks, sleep deprivation, abuse from senior colleagues. So when you're working 100 hours a week, there's not really a lot of time to balance your personal life with that type of demanding job approach. Then you've also got this attraction to fintech that we talked about. And bankers are turning to fintech for the same reason that consumers do. They're both fed up with how this legacy banking system operates. The fintech sector is pushing this really consumer-centric, innovation-first philosophy, and it's really attractive to junior industry executives. Moreover, fintech growth across services like banking and lending, that's adding a lot of job opportunities. And industry faith in fintech has grown such that investments in the sector hit $21 billion last year. So you've got a dissatisfaction with work-life balance. You've got more younger talent gravitating towards this fintech world. And then during the pandemic, you had non-customer facing banking employees that started to work from home and realized, hey, you know what? This is fine. I don't need to commute to the office every day to do my job. But meanwhile, the ones who had to stay in the office had to deal with that pandemic thing, and it affected them. 37% of financial services employees felt that the pandemic had a negative impact on their mental health. 13% said it had a negative impact on their physical health, and 22% felt that it really took a toll on their workload as well. At the same time, this is a pivotal moment for Finserv to carve its place in society. And there's a couple opportunities here that Finserv can be taking advantage of and is taking advantage of. First of all, we have the environmental and climate approach with ESG initiatives. That's environmental, social, and governance strategies. So things like negative screening, where you exclude or avoid transactions that aren't aligned with environmental, social, or ethical standards, or positive screening, where you're selecting corporate borrowers that score high on ESG factors, integrating corporate ESG issues into financing decisions, and then thematic investing, which is prioritizing the companies and projects that are aimed at positive social change, be that climate or gender equality, for example. There's also an underserved market, and there are several underserved markets that we could talk about, but the one that I thought was most relevant to this particular moment was gig workers. So it's estimated that 25% of the US workforce is involved in the gig economy. And actually, some experts are estimating that even higher, closer to 35% post-pandemic. Gig workers are underbanked. They don't have access to the resources to grow their financial wellness. And that's because they're earning these erratic incomes, and it's making it really a lot harder for them to qualify for consumer loans and mortgages. They really lack a lot of the protections and benefits that other workers are able to enjoy. But this demographic isn't going away. And so this is a moment for Finserv to meet the needs of this demographic and start thinking of creative ways to engage them. You also have these niche financial institutions. So there's this hyper-personalization emerging with financial institutions like Daylight, which caters to LGBT customers. So there's an opportunity to really micro segment for Finserv. And then you have unmet demands among aspiring affluent consumer demographics. And I was actually talking to a friend of mine the other day about just this exact thing. Her and her husband have saved up a little bit of money. They're not rich by any means, but it's a little chunk and they want to be able to do something with it. But what they're finding in their research is, yeah, we have a little bit, but we don't actually have enough to work with a traditional advisor. And so they kind of feel like they're in a bit of a limbo right now. I want to address my financial needs, but I don't know how to do that because I don't have the level of wealth that is required for some of the things that I want to do. And so there's all these opportunities right now for Finserv to take a look at some of these options and carve their place in society and make an impact there. Of course, every industry, especially right now, we need to consider cyber risks. I think the White House just did a press briefing yesterday about how they've been warned specific companies about potential hacking and data breaches by Russia. So unfortunately, Finserv is not immune to cyber risk. There's unencrypted data, there's malware on end user devices. If you're employing a third-party vendor to develop services for you and they don't have solid cybersecurity policies, you got another issue. And then there's this whole idea of spoofing as well, where hackers are impersonating a bank website's URL to steal their login info. On top of that, you've got competition from big tech. In a recent survey, more than 40% of US digital banking users said they would trust PayPal to provide them with banking services. And analysts are seeing that as a signal that big tech is going to continue to push into banking. And as they do, they're really going to become an even more viable competitor for banks. And then, of course, the impact of crypto, which honestly, crypto could be its own webinar. But, at a high level, traditional banks are hesitant to adopt the use of crypto. Understandably, they believe there's an inherent risk there that outweighs the benefits. It's a very decentralized nature of currency. And the way that it's viewed is that it undermines the authority of central banks, leaving some to believe not only will they not be needed anymore, but they're going to be unable to control the money supply. In addition to that, the price of cryptocurrencies, if you look at even Bitcoin specifically on this example, they've generally been volatile over their short life. However, banks can and should embrace this technology to stay competitive, and many of the big names already are. JP Morgan has taken on 2 cryptocurrency exchanges, Coinbase and Gemini, as banking customers. Fidelity Digital Assets is creating a crypto fund, and PayPal is now accepting cryptocurrency transactions. So the good news here is that banks can actually play a significant role in the crypto industry. And hopefully by doing that, they will add some much needed assurance and security to this largely unregulated environment. And then last but not least, we've got the elephant in the room, neobanks. So challenger banks are feeding on low satisfaction with mainstream banks. They are leading in customer satisfaction with 83% satisfied customers in the US and 76% satisfied customers in the UK. Now, this graphic here is showing the feelings of US banking consumers on traditional banking and Finserv outlets. And we are seeing with those traditional ones, they are most satisfied with credit unions and least satisfied with the top 50 global banks. That might not be a good situation to be in. But the question is why? Why are neobanks pulling ahead at the rate that they are? There's a couple of factors that we need to think about with that. First of all, they have a really strong cost efficiency and innovation structure. A recent Oliver Wyman study found that traditional banks are taking about 3 to 6 months to launch a new feature, while these challenger banks are doing the same thing in a couple of weeks. Their cost of acquisition is also lower, around $1 to $38 compared to $200 for a traditional bank. So Monzo in the UK is a great example of this. They spend under $9 per customer on customer acquisition of a primary account. And then the cost efficiency ratio isn't quite as stark, but it's still notable. Their cost efficiency ratio is 46% compared to 50 to 60 for most traditional banks. So they're super focused on cost efficiency, super focused on quick innovations and quick feature launches. And then tied in with that, There's this focus on the digital customer experience and simplifying of processes. So location agnostic banks are collaborating now because they're seeing an opportunity. So they're looking at local and global banks and fintechs, and they're thinking about ways that they can expand their cross-sell and rebundle services through tight-knit integrations with those types of companies. Here's one example. Allior, Solaris, and Raisin's backed by PayPal, they joined forces with MasterCard in 2018 in Europe, and they rolled out an open banking platform based on APIs. That is key. The API conversation is going to come up here again later, so keep that in mind. And what that did was it automated accounting and cash flows for SMBs and freelancers. Then there's Counting Up, which was a UK-based neobank, did the same type of approach. They partnered with a local bank, and they enabled instant automated expense recording for small businesses with real-time insights into the health of the business. So they are capitalizing on this digital convenience opportunity. And then there's this banking as a service model. And here's that API conversation coming into play again. Creating open banking through API connections, using mobile only to the greatest advantage, which has super low customer acquisition costs. Not depending so much on third-party development or fintech to get their innovations done. And real-time data integration and management that is not only helping on their end, but is signaling to the consumer that there's a level of convenience and simplification there that they can enjoy. And they're also doing this open ecosystem approach to allow access to external developers. So you've got that low cost structure and you've got that simplified user experience, giving neobanks the ability to offer these faster and more transparent models. But here's another chart from Finovate Research that is showing just that. And what I particularly want to focus on here is the user experience with feature-rich apps and tools. So remember on that last slide, we saw neobanks can launch a new feature in a couple weeks instead of the months that it might take a traditional organization. So delivering on these quality user experiences is happening a lot quicker, and it's easier for them to accomplish. Overall, what we can see from this data is they are outperforming mainstream banks in the minds of consumers in nearly every function. But this user experience and this low cost structure are two of the most stark differentiations